Hello everyone and welcome back to Dimes to Dreams. So in our previous videos, we discussed how you should invest part of your money in ETFs, how you should set up a savings plan for monthly investments and so on. But the next obvious question is, how do you know which ETFs to pick? There are so many options out there. How do you know which one is right for you? That is what we will discuss in today's video. Let's get started. What you see on your screen is a website called justetf.com. This is the tool I like to use to identify the right ETFs for me. I will add the link in the description below, but you can also go for any other website that will give you the right metrics like the total expense ratio, the past performance, the volatility, and so on. These are all the things that we will discuss throughout the course of this video. What we will do first is go to ETF scanner. And as soon as you go there, you will see that there is a list of ETFs that you can buy. But before you start picking ETFs, you first have to decide your investment focus. The first step is whether you want to invest in equities or bonds or metals, commodities, crypto, and so on. I will go to equity, keep it simple. And then you have to decide which region or country or sector or strategy or theme you want to invest in. So what does it mean? It means that the first step for you is to decide what kind of ETF you want. Where do you want your money to be invested in? Do you want it in emerging markets or do you want it in Europe or the United States? Do you want it in the technology sector? Do you want it in the agriculture sector or healthcare? Or do you want it in a particular theme? Like, do you want it in, let's say, AI or cloud technologies? Or do you want a particular strategy, like you want a dividend ETF or you want a growth ETF or large cap ETF? So region, country, it's self-explanatory, right? You pick a country or you pick a particular region that you are interested in. Let's go to sector. So sector is where you can choose all the different industries that you can invest in. So I invest heavily in the technology sector, and you see that a lot of people do because it has the highest number of available ETFs, at least as per justetf.com. And if you can also go for a particular theme you're interested in, you can go for artificial intelligence. It's quite a popular theme right now. You can go for climate change, cloud technology, digitalization, fintech, or many other options. So the first step for you is obviously to decide where you want your money to be in. If you want dividend ETFs that will pay out a quarterly or a yearly dividend with a high dividend yield, you can go for dividend ETFs, or you can go for growth or large cap ETFs. Equal weighted basically means that if the ETF is buying 10 or 20 stocks, each of those stocks will have the same weightage, which is usually not the case, but for equal weighted ETFs, that is how they are made. For this demonstration, I will filter by technology. And what you see here is a list of technology ETFs that you can buy with some key performance indicators here. You can go to select columns and filter what kind of information you want to be displayed when you are comparing these ETFs. So let's go through the columns one by one and see what they mean. The first column you see here is called fund currency. You will see a lot of US dollars and a few euros here and there. So for someone like me who is living in Germany, the currency in which I will invest is euros. So what happens when I have a fund that's in US dollars? It means that I have an additional forex risk. So when the US dollar to euro price is not favorable for me, I will lose some money. Should you then reject all US dollar ETFs? Absolutely not. Why? Because if you take the example of the first few funds, you will see NASDAQ 100, S&P 500, EQQQ NASDAQ, and so on. So these are all ETFs that are tracking indices based in the United States. So most of the time, in such cases, if the fund currency is US dollars, you will have physical replication ETFs, which means that the ETF is actually buying all the funds that you're investing in. So NASDAQ 100 has 100 companies and the ETF will actually buy shares of those 100 companies. That is called physical replication. The alternative is synthetic ETFs. Synthetic ETFs usually have a contract, a swap-based contract with an institution who promises to track the index. There is no direct answer to which is good or bad. But these are the different options that you have. So just bear in mind that you should not straight away reject US dollar ETFs, because as you also see, there are a lot more options when it comes to US dollar based ETFs. So the next column you see here is called fund size. And this is important because having a higher fund size means that the ETF has more liquidity. So they will usually have a tighter bid-ask spread, which means it is easier for you to sell the ETFs and when the time comes when you want to sell, with lower trading costs. So keep in mind that you should have a high fund size. So here we see the first ones have 13 billion, 7 billion, 6 billion. This is a really large fund size, but as a rule of thumb, I prefer not to go below 10 million, or I would say even 50 million. So anything below 50 million, I try to avoid. But again, if you see a great opportunity, you can consider it. Just look at the other factors, because no single factor can determine your decision, but it's always a combination of these factors. So I try to stick with ETFs that have relatively large fund size, like more than 50 million euros. Next one, this is, I think, extremely important. This is called TERPA. TER stands for total expense ratio. PA is per annum. So total expense ratio is how much money you are paying to the ETF for their service, basically. I mean, the ETF is tracking an index, right, and giving you returns based on it. So for that, you are paying them 0.33% of your investment in the first case, or 0.15, and so on. So I recommend keeping your TER below 50, like 0.5. But again, there's no rule of thumb for this, because if you are going for emerging markets, you will often see that the TER is sometimes higher than 0.5. But if you really want to invest in emerging markets, you can still go for it if the return is good. But for other cases, usually I try to go for funds which have TER below 0.5%. Next, 3 columns I will discuss together, because this is basically how well the fund performed, how well or how poorly the fund performed over the last year, the last 3 years, and the last 5 years. If we look at the first one, in the last 1 year, it gave 18% return. Last 3 years, 30%. Last 5 years, this is great, 143% in 5 years. The next one is even better, like 193.02%. So when you are looking at the returns, you also have to see what kind of companies they are investing in, and it's not always that simple. For example, we see a 193.02% return here. So if we go into the details, we can see their holdings, and we see that they hold a lot of Microsoft, Apple, and Nvidia, and these are Mac 7 companies, Magnificent 7, which have done really well over the last couple of years. So does that mean they will continue to do well over the next few years? Maybe, maybe not. We don't know. So you should always look at the holdings when you are looking at the performance, because that can because as you know, Nvidia has gone up massively over the last year. So I would account a lot of the performance over the last 1 year to Nvidia. So let's go back, and we see that we can compare the different results, and we can get an idea of what kind of return we can expect in the future. Also keep in mind that past performance is not indicative of future results. So the next field we are looking at is volatility. Here we see volatility over the past 1 year, but if you go to select columns, you can filter for the last 3 years and 5 years and so on. Volatility basically means how much the stock price, or rather I should say the ETF price, can fluctuate within this time period. So in this case, 1 year. So we see the first fund has a volatility of 7.63%, second one 21.33%. So volatility, in simple terms, the lower the better, because you have lesser risks. But why do people go for higher volatility? Because it also often comes with higher returns. As you can see, these funds have given us like over 100%, close to 200% over the past 5 years. And it comes with a high amount of volatility. But if you go for some other sector, like let's say, if we go to consumer staples, you will see that the volatility on average is much lower compared to the technology sector. But you will also see that the returns are much lower. You have had 35%, 50% negative in this case, 50%, 30% return over the past 5 years. So it all depends on your risk appetite. How much volatility are you willing to handle? Technology sector is high growth but high volatility. So you can also go for different sectors to balance out your risk. It is also important to remember that volatility is not the only risk that you need to assess. How much time you spend in the market is also equally, or I would say more important. So, historically speaking, if you had been invested in the market for a period of 10 years or more, you are much less likely to lose money compared to if you were invested for 1 year. Why? Because within that 1 year, you could be in a bull market, you could be in a bear market, you could be in a recession, you could be in euphoria. There can be so many factors, right? But over the long term, these factors are not so important. So, if I draw a parallel to cricket, I don't know how many of my viewers enjoy watching cricket, but I think of stock trading like T20 cricket when you are trying to score runs quickly, and think of investing as test cricket. So, you are here for the long run when you're investing. The next one is inception date. So this is important because this helps you assess the past performance. If a fund has just been recently released, you do not have any data to look at, so you don't know how to assess the performance of that fund. So I would say go for any fund that has at least 5 years of past performance for you to look at. Next is distribution. Distribution means when the stocks that are in the ETF are paying out dividends, what happens to that dividend? Distributing means you get the dividend, so it gets paid out to you. Accumulating means that those dividends get reinvested and gets added to your total portfolio. So it has a further compounding effect, which can be what you're looking for, or you are looking for a steady source of revenue, then you can go for distributing ETFs. And next we have holdings. Holdings means how many companies are there in that particular ETF. There is again no right or wrong answer for this. You can go for a fund that has a lot of holdings. You can go for smaller holdings. That's entirely up to your investing strategy. Last column, dividend yield. So let's go to our filters here and go to dividend equity strategy. So here you will see higher dividend yields. So this will help you pick funds, and you see all of them are distributing because these dividends are focused on regular source of income for you. So here dividend yield becomes useful because you might want to pick based on a high dividend yield. But also it's important to remember that dividend can be a double-edged sword. Usually 3.4%, 4%, 5% dividend, yeah, it's common. You will see those numbers. But when you see an excessively high dividend, I would recommend you go and look at the performance of the companies those are that are in that particular ETF, or if it's one particular company you are buying and it's giving you a very high dividend, it's something to be skeptical about, because often companies who are struggling and investors are pulling out their money, those companies often give a very high dividend to keep the investors invested in the company. So you should be wary of that, because if the stock price is going down, even if you are getting a high dividend, you are losing money because your capital is going down, and dividend is a percentage of your capital. So if you invested 1,000 euros and with a 10% dividend yield, you are getting 100 euros, yes, but after 1 year, if the 1,000 euros becomes 500 euros, not only did you lose 500 euros, but you are also getting only 50 euros in dividends now with that 10% dividend yield. So that is something to keep in mind when looking at dividend ETFs. So now that we have looked at the basics, let's dive a little bit deeper. So we can click on any of the funds that we find interesting. I will just go with the first one here. And here right off the bat, you will get much more information. So you will get charts where you can see the overall performance over time, or the year to date, 5-year chart, and so on. If you go further down, you will get a lot of data, like this tells us which index they are tracking, what is the investment focus, physical or full replication. As I mentioned before, this means that the ETF is actually buying the funds that they are investing in. Strategy risk long only, which means they only buy, they do not sell. They are not shorting any of the stocks. Fund currency US dollars. Currency risk, unhedged, this is what I also mentioned before. So if it is unhedged, you are susceptible to the risks of forex fluctuations. So if the US dollar to euro value is not favorable, you will lose some money. However, you can also gain some money from a favorable forex changes in the forex market. Then we have volatility, inception date, fund domicile. So where is the fund domiciled in, and the company who is providing the fund. You can go dive deeper into the holdings. So this is, I think, very important. As I mentioned before, I think it's important to know which companies the ETF is investing in and what sectors they are investing in. So of course, here we have mostly technology sector, as we can see clearly, and primarily in the United States. We can then look at performance, as we have discussed, how they have performed over the past year, 5 years, 3 years, or past month, past 3 months. So I always recommend keeping a long-term view. Although these are also important values, but this value, the past 5-year performance, should be the most important for a long-term investor. So finally, if we go back to overview, we will see that there are a few documents available that the fund provider has provided you to help make your decision. So if we go to Factsheet, for example, here we will find a few more details about the fund. For example, what kind of risk assessment they have made for this ETF, what are the portfolio characteristics. So in our next video, we will discuss how to pick stocks, and that's where we will talk about the meaning and the relevance of these terms such as price to book ratio, PE ratio, and so on. And yeah, here you can get some more information, like how well they have tracked the index, cumulative annualized performance, and so on and so forth. So we have come to the end of our video. Of course, I was not able to cover everything, but I have tried to touch upon the most important points. There could be various other factors that determine your decision, but in the end, if you follow these steps, you will be able to build a strong, high growth and resilient portfolio for yourself. Thank you for watching Dimes to Dreams. If you like this video, then hit the subscribe button and bell icon below, and I'll see you in the next one.